makes you so sick at heart that you can't take part. You can't even passively take part.
I've been meaning to make a video on crypto for quite some time now because it's a topic of interest to a lot of people, and it's also a topic that many people struggle to understand. And even myself with an economics degree, it's not easy to often grasp some of the concepts underlying crypto and its technology. So the real impetus for this video was also that I was challenged on Facebook to respond to a couple of articles that were sent my way, which dealt with crypto and the democratization of finance, which I feel I need to debunk. So this video is to debunk this myth that crypto is democratic. And I'm going to read one of those articles in full. It's not too long, so you can get an idea of what the misleading arguments that are being used here. And also read a bit of another article which deals with a related but separate issue, which is tokenization. And you may have read news about NFTs, so I'm gonna talk a bit about what that is, and just a sneak preview of what follows. I actually find tokens to be less egregious than crypto, so stay tuned if you want to hear why I think tokens are actually not as bad as crypto itself. So let's start reading this article, which is called Crypto and the Democratization of Finance. Keeping assets circulating among structures and across jurisdictions allows them to move through the regulatory apparatus of nation-states in a nearly frictionless manner. Looking at the above quote, you might think this was a statement about cryptocurrencies like Bitcoin, Ether, or Maker's DAI. But in fact, it was a comment about the centuries-old wealth management business. Wealth management is an industry driven by a professional class for the wealthiest members of society. Wealth management provides a range of services that are driven by trust foundations and charities. The individuals that use these structures can buy the best legal, tax, and regulatory advice. This advice and the structures give them a unique outlet from many fiat monetary systems. So, first red alert is the word fiat. Whenever you hear the word fiat, it's probably a libertarian or an anarcho-capitalist. Economists never use the term fiat at all, unless you're actually making comparative analysis between modern currencies, all of which are fiat, and non-fiat currencies, that those are the ones that are based on an underlying asset, like gold. So unless you're making like a comparative analysis of currencies, there's no need to use the word fiat. And so libertarians love to bring it up just because they hate fiat currencies, and they just want to make it look like these are kind of evil by default. So that's the first red alert, and should give you a warning sign of what the underlying ideology of the person writing this thinks. But what about the rest of us? Where does the average citizen go to protect their holdings, savings, or try to accumulate wealth? It's very badly written, I should add. Well, the answer is that with the advent of Bitcoin and the entire cryptocurrency space, average citizens now have their own outlet. They don't need a trust foundation or charity. They don't need paper gold or a few physical coins. All they need is a hardware wallet. So one of the argumentative tricks that this article is going to do is that it's going to shift from describing crypto as a wealth management service and then subsequently as a high return investment. And you can't have it both ways. And I'm later going to explain why. But for the moment, I just want to point out that the average citizen does have ways to protect their holdings or savings. These are at the most basic, a bank account. Now, bank accounts I would not advise for like long-term savings, because interest rates are really low. They can be lower than inflation. But you have other options like an investment fund, which in the US are called mutual funds. These usually require maybe $500, some more, some even zero. So they're not out of the scope of a small investor, which has only small savings. I mean, I'm not rich or wealthy in any way. I have an investment account. So this is not out of place. You pay a fee, and a lot of people who describe or argue in favor of the democratization of Bitcoin is that, hey, we don't pay fees for storing our money in crypto. I don't think that's an argument for democracy. I'll explain a bit more later. But yes, in most investment funds, you will pay like on average, like a 1% assets under management or AUM fee. That's kind of standard. Now, wealth accumulation, which they're relating to with wealth management, is similar in concept to an investment fund, except it gives the scope for transferring that money into different jurisdictions and having other options like, tax loopholes or putting them in tax havens, etc. But the broader concept is the same. It is a place to safely store savings. It's not a high risk environment. And we'll see as this article goes on how they're going to shift from describing crypto as wealth management and then as high risk. But I just want to make it clear. Wealth management simply allows rich people to have like a sustained higher level of returns on their savings, but still it's designed to be fundamentally safe. They're not gambling that money away by using a wealth management service. So, what is financial democracy? Democracy is a funny thing. It appears to be one person, one vote, majority rules, and other almost cliche statements. Democracy is, however, a complex term open to interpretation. So if I say democratizing finance, what does this mean? Democracy is about having agency and the ability to make choices. It is the ability to make a vote on something, whether it be a representative, an idea, or a product. Votes come in different forms. You can vote through purchases or hodling of an asset, or you can vote by being investing. Spell check, bro, or grammar check. In a given project, startup, or idea. It could be developing a community around an idea, project, or concept. So democracy, in a sense, is the ability to make choices. That's not what democracy is. And here's another trick that he's using, which is define democracy in the most vague, generic way possible so that now anything can be democracy. Define voting in equally generic terms so that anything can be a vote. I mean, this idea that developing a community around an idea, project, or vote is inherently a vote is ridiculous. That's not what voting is. And this reminds me of the notion of like voting with your wallet, which is not really voting. And it also reminds me of the Thatcherite concept of shareholder democracy, which is when Thatcher privatized a lot of state-owned utilities in Britain back in the day. The argument was, well, it's more democratic than under state ownership because any citizen can basically own a share in these companies, except you really aren't controlling the company in any way just because you own a few shares. I mean, it's going to be the people who have the largest amount of shares, which will probably be institutional investors, who are really going to have the voice and vote in how the company operates. But even then, even knowing that shareholder democracy is not democracy, it still is more democratic than crypto, because at least you can go, even if you have one share in a utility, you can go to the shareholder meeting, you can bring a protest sign that the CEO is an idiot. You can't do that with crypto because there's nothing about crypto that you vote on. It's not even based on an underlying asset. And this is so hilarious. Like libertarians hate fiat currencies. And yet there's nothing more fiat than crypto, because at least the share is based on the performance of the underlying firm. At least a bond is based on the underlying performance also of a firm, or if it's a sovereign bond, a country. And even fiat currencies are based on the performance of that country. So crypto is not based on anything. It's more fiat than the fiat currencies. So, if it's based on like Elon Musk tweeting Dogecoin, really that's an asset that you think is safer than actual other, like an investment fund. You got to be kidding me. So take note. That's the next part of the game. Let's just define democracy in the vaguest way so that we can apply it to anything, including crypto, without actually demonstrating how you empower people. Because I've never heard anyone any crypto defender, give me like concrete examples of how crypto empowers people in practice. Anyway, let's keep on going. Protected from getting ahead. Traditional financial regulations are designed to meet a series of important goals. One goal is to define the playing field of a given activity in the financial space. Another is to lay out a series of principles to define the rules and within that playing field. The outcome is to shape ethical behavior and just actions instead of unethical and criminal activity. So this is regulation, basically. These efforts are in many ways defined around the concept of protection. Rules protect citizens from greedy, self-interested parties in and outside of the financial industry. The idea is that protecting the customer from these individuals, the integrity of the system is protected. They are often protected so well that they have their agency removed. There we go, the nanny state argument. They don't have to assume responsibility for the decisions. They are so well protected that they cannot assume risks necessary to get ahead in many cases. And if the system fails, they have nowhere to go, lacking the high-ticket professional advice that keeps wealthy client funds flowing around the world. Then along came Bitcoin. This is a classic libertarian pull yourself by your bootstraps argument, individual responsibility above all things. The reason that we have regulation for example, investment funds, or an even better case, pension funds, is precisely to protect the investor. For a pension fund, you are very limited in the type of assets that you can invest in. The whole point is you cannot invest in high-risk assets or high-risk asset classes because the risk is putting a pensioner into bankruptcy at a point in their life where they cannot accumulate more capital or they can't accumulate more savings. That's why you have those protections. Now with investment funds, it's kind of the same because a lot of the people who invest in these, in mutuals and these kind of things are small investors. It's a small amount of savings that they have, and you have to protect them in some ways. Now, is it unfair that rich people have access to higher risk and higher rewards? Yes. But then again, the whole point of this is because they have wealth to spare. Rich people also don't put all their assets in high risk investments. They put a fraction of those into these investments because if they lose it, it's not a big deal. So, for example, a hedge fund, depending on there's many studies, but the death rate of hedge funds every year is anything from 3 to 10%. So that's huge. Do you want to risk putting the savings of small investors into an asset class that potentially has that degree of failure? You don't. That's why you have regulation. That's why you protect small investors. Now, there's a broader argument to be made of, well, why do rich people have this ability to generate passive income with high returns and in some cases not even work for it? But the other side of the coin is like, why are there so many people with such limited capital that they can't access these higher these more sophisticated investing methods? Why are the people who argue for crypto never argue why people don't have capital? There was a study done by the Fed a couple of years ago, I think it was 2018, that showed that only 40% of Americans could raise $400 for a medical emergency. That's how little capital most people have, even in the richest country in the world. And there's no argument of, like, how do we spread the wealth? Do you think these crypto douchebags are arguing in favor of wealth taxes? Of course they're not. Do you think they're arguing in favor of inheritance taxes? They're not. Of course they're not. They're libertarians. They're arguing for less taxes. They're arguing for less redistribution. They're arguing for less regulation and less protections. And this is what's so absolutely insane. I mean, this is demented. There's no other word that I can use other than this is demented. The idea that you can only get ahead in society just because you can access high risks. I mean, this is basically this whole winner take all mentality, loser gets fucked. That's the kind of world that libertarians want to live in. And there is absolutely no way that any sane human being would think that opening up your access to a high risk investment is the only way to get ahead without addressing all the other reasons why in the US you don't get ahead. It's demented. It really is. And also note how they now shifted the argument. What I said at the beginning, that first they're going to use the argument that crypto is like a wealth management service. Oh, now they shifted it. And now it's a high risk, high reward investment. And you can't have both. This is squaring a circle. You cannot have both. Owning crypto is a vote. Bitcoin, the granddaddy of the crypto space, started with a few nodes and transformed into thousands distributed around the world. Driven by math, it is the first money system outside of the modern financial system that has scaled in any way. Bitcoin and its spawn, Ether, Bitcoin Cash, XRP, Bitcoin SV, Dash, Litecoin, and thousands of others have created a form of financial democracy. If democracy is an agency and a vote, then crypto is a true financial democracy. And it's a unique way for citizens to get some advantages of wealth management without the wealth manager. So, again, we haven't defined what democracy is. We're just using this very vague concept that can be applied to anything. And again, it's now we went from it's a high risk, high reward investment to back to wealth management, and without the wealth manager. And that's the argument of it's democratic because you don't pay fees, and that's ridiculous. Because, for example, in Britain, ATMs don't charge you fees. So is the British financial system more democratic? Of course it's not. The conception of democracy of a system is not dependent on these fees. You don't need a special status to participate in crypto. Average citizens and investors with small accounts are excluded from investing in high-risk prospective companies. Now we're back with the high-risk argument. Every section of this article just moves from wealth management to high-risk. Wealth management, high-risk. The rules around this, called accredited investor rules, limit who can participate in these projects based on means, as in how much income you have and the number of assets you hold. The emphasis is on the ability to sustain losses, but it also implies that a person with money has superior insight. The number of accredited individuals in any nation is a small fraction of the total population, giving them special access to vote on what does and does not get built. They get to vote with their money and exclude votes for everyone else through regulation. So, in the US, you have these accredited investor rules, which I assume that in other countries you have some equivalent to. And this is what basically, once you get this status, then you can invest in some very high-risk asset classes like hedge funds or private equity. And again, the reason why there are these limits to who can invest in these things is because they are high risk. And because you need to protect, because then you can just sell all these asset classes as and they'd love that if anyone could just jump in and invest in them, and then they'll all get fleeced. So there's a reason why they're protected. Now, again, there is a broader argument of why rich people have access to these services and most people don't. But this has nothing to do with crypto. Crypto doesn't really change this in any significant structural way. And the people who support crypto don't make any arguments on wealth redistribution, which I just explained. So let's keep reading. Early crypto adopters voted on Bitcoin and numerous other projects leading up to the 2017 boom. Many of these failed, and others were outright frauds, but many good projects remain. That's a real great way to sell it. It's you don't know if you're investing in a scam or not. A small but growing contingent of knowledge workers and enthusiasts were permitted by the creation of Bitcoin to vote without the accreditation. They were permitted to take risks and own the results, including responsibility for losses. It's a new form of financial literacy. So apparently financial literacy is bankrupting a small investor, so they learned the lesson. And God knows if they're going to be able to accumulate capital again. If you're an Uber driver who saved $1,000 after 5 years, your lesson in finance is you were convinced to invest in Dogecoin before Elon Musk went on Saturday Night Live and made some bad jokes. So I'm sorry, this is you can't flip the argument every section of this piece into making it seem that crypto is a safe way of managing wealth, and then that, the only reason you can get ahead is if you take massive risks. This is ridiculous. Gold isn't a vote against. It is part of the system. I'm going to skip this bit because it's basically, I think, trying to compare, make it seem like crypto is an alternative to gold, because in times of crisis, people go into gold. I don't think it's an applicable analogy in any way. You can own a few satoshis as a hedge. As people in various countries have discovered, without expensive wealth management advice and structures like trusts, foundations, and charities, your savings are always at risk. They are protected by the system with various insurance elements added to instill confidence, and they are protected from fraud and malfeasance, except for fraud and malfeasance by their own government. You can see where this is going. Crypto has provided a safety valve for the average citizen to move assets outside of the system. In Venezuela, they have used Bitcoin, Maker, and others to escape tyranny, although it was too late for some. Another classic libertarian argument, let's compare with the lowest bar, the biggest economic basket case on the planet, which is Venezuela. And, some people were able to take their money out of Venezuela through crypto. That's great, by the way. If you're Venezuelan and you manage to secure some of your savings through crypto, that's fine. I'm totally in favor of that. But this assumption that this could happen, this is really what it is. This could happen in the US tomorrow or in a couple of years. So you need to be prepared. This is classic libertarian paranoia. And this is just like, I'm not saying that there is zero chance of this happening, but it's so low that you just can't live your life and make financial decisions based on this highly, highly unlikely possibility. And let's be honest, if you're a tyrannical government, you can close off your country to the internet and you can close it off to Bitcoin. So, China controls the internet in its territory. You can control social media. You actually think they can't block Bitcoin if they wanted to? Come on. Of course they can. Tyrannies will become tech savvy. I can guarantee you that. Now, the average citizen in unstable banking and government environments can use a wealth management type structure to protect their holdings. They can move it out of the official system for as long as they want. They can transfer it, exchange it, use it as money or a hedge. Now, average citizens around the globe can protect some of their wealth by using Bitcoin and other cryptocurrency products. They have access to a structure managed by math and secured by computers. And it's the cheapest wealth management product on the planet. So we ended back on it being wealth management. So I honestly don't know what else there needs to be said about this piece. If it contradicts itself in every single section and describes crypto as having the characteristics of different asset classes that are contradictory. You cannot be wealth management and a high risk, high reward investment at the same time. You just can't. So I think there's an argument that many people have given of think of the people who have very small investors who have seen their investment multiply by the hundreds by investing in crypto. But that's still a drop in the bucket. Here's Dogecoin, and I love Dogecoin, not just because of the name, but just because it was practically worthless until this year. And at its best, so this was right before Elon Musk went on Saturday Night Live, and then it just collapsed. At its highest, it was worth 0.70 something, whereas before it was worth 0.002 or 3. So the difference is about 200 times. So if you invested $10 in Dogecoin back in the day, as in last year, you would now have 2,000. If you invested 100, you now have 20,000. That's not unsubstantial if you're, a middle class or working class person. I'm not going to deny it. But if this is the value and sort of the lack of movement in an asset at this point, you can broadly say that the market cap of this asset is not very high. That is, there's not really that many people investing in it. So let's assume that you made a number of people who invested in Dogecoin, I wouldn't say wealthy. Even if you invested 1,000, you would have 200,000, which would barely get you a mortgage in Brooklyn or London. So most people probably didn't invest 1,000. I can absolutely guarantee you. And is that like wealth redistribution? Like, how many people were investing in Dogecoin at this point with this little value that it had? Estimating the market cap of Dogecoin at this point, like, this is a drop in the bucket in terms of wealth redistribution. So the irony is that the more that crypto becomes mainstream, the less you'll see these fluctuations. So Bitcoin, whether it's Bitcoin, Dogecoin, whatever, the only reason they're high risk and high reward right now is because their market cap is so low that its fluctuations are much higher. Basically, it's easier to cause market fluctuations in their price. The moment that they become mainstream, the moment that like big institutional investors have positions in crypto, so the moment like BlackRock, Vanguard, State Street, investment banks start pouring money into crypto and start building portfolios in crypto, it will be more stable. It's going to stop being a high risk, high reward investment. It's going to look more like wealth management, perhaps. But it also means it's going to be less democratic, because the people who have small investment will have less say in how the currency behaves. And this is, taking the very loose definition of democracy that this author is using, which I disagree with. But rest assured that the more mainstream crypto becomes, the more institutional investors will be the ones determining how crypto behaves, and the less you will have a vote. And this kind of defeats the whole argument of it being democratic, it seems to me. And further to a point, these people don't argue. I don't hear them arguing. Like, why on earth do we have companies like BlackRock, which are so dominant in terms of the amount of assets that they have under management? Assets which, by the way, they didn't save, because they're basically controlling assets that you saved. So they're not criticizing this aspect of the system. They're not criticizing the fact that if people actually owned, or rather, if their savings, they had a voice and vote in their savings, that would be more democratic than just investing in fucking crypto. Because rest assured that BlackRock, when it uses your savings to invest and become the primary shareholder in some other company, and they're going to use that power of their ownership in that company to, say, lay off workers to make it more profitable, that goes against your interest as a class, as a working person. But you won't hear that criticism at all from the people who are defending this absolutely idiotic notion that crypto is democratic. And even now, even in this situation of a very low market cap, crypto is already hugely unequal. So here was an estimate. I'm gonna copy the link in the description. Here's an estimate of the Genie Index of Bitcoin and Ethereum. And if you don't know what the Genie Index is, it's a measure of inequality that goes from 0 to 1, 1 being perfect inequality. That means one person owns all the income or wealth, and 0 being perfect equality, that is, everyone owns the exact same amount of income or wealth. And the OECD average is like 0.35. Some of the more egalitarian Nordic countries are like 0.25. The US is 0.40 something, so it's rather unequal by developing country standards. Well, this is the Gini of Bitcoin and Ethereum. So it's in the 0.8, 0.9, generously 0.7 range. Does this look like a very egalitarian and democratic asset? Of course not. Now, wealth inequality is much higher than income inequality. So if those same countries that have Ginies of 0.3, 0.4, their wealth inequality is going to be much higher. It's going to be like 0.7, 0.8. So this is not different than like standard wealth inequality. This is not what I'm saying is almost every asset class, I assume, will have some Genie Index similar to this. And this chart, which is from the same blog post, says Bitcoin, the wealth distribution of Bitcoin, 4.11% of addresses own 96.53% of Bitcoin. Are you fucking joking that this is democratic? Again, it's absolutely demented to think that this is democracy in finance. And I will repeat, this is not different. Like, maybe it's actually a more egalitarian distribution than other financial assets. I want to make it absolutely clear. The financial system under capitalism is not democratic and never will be. And unless you change the underlying structures of how finance behaves, no amount of new assets that you create, like crypto, is going to change that. So I really challenge anyone who disagrees with what I've just said over the past 30 minutes to give me a concrete example of how crypto actually empowers you. Because I have never heard a single example. And the examples that they give are in line with this very vague, generic definition of what democracy and what voting is. But in practice, how does crypto empower you? It doesn't. And the people who promote crypto are the ones who actually want to deny empowerment of people in ways that matter. Because they don't talk about redistribution. They don't talk about taxation. They don't talk about structural change. So, I'm sorry, crypto is not democratic in any way. Now, the other aspect that I wanted to talk about is tokenization. And here's another article that is crypto was meant to democratize finance, and it's finally about to. I'm not going to read the whole thing because a lot of it is just it's even more vague than the previous one. But this one talks on the issue of tokenization, and I want to explain what tokenization is because you've probably heard it from NFTs, which are non-fungible tokens, and NFTs are rather ridiculous, to be honest. I mean, it kind of is snake oil. NFTs are basically, you've seen, like, for example, the case of selling a meme as an NFT. And there was, like, the most recent one was that girl who's, like, smirking in front of a burning house, which was a meme a couple of years ago. And now she sold that as an NFT for, like, $500,000. That is, like, the ridiculous part of tokenization, but I want to describe what tokenization is in essence, because actually I'm not opposed to it, which is what I said at the beginning of the video. So tokenization is basically taking an illiquid asset and making it liquid by inserting it into a blockchain. And this basically means you have some asset, for example, ownership of a company or a planned company, like if you want to like crowdfund a company. And you insert it into the blockchain, you divide that asset into different bits, and you sell it off. And this is basically similar to an IPO, an initial public offering, which is what companies do when they want to go public, when they want to share their stock, and they usually hire an investment bank, which then determines what the value of the firm is, how much the shares are going to be worth, and then they put them in the open market. They basically buy those shares. The investment bank buys the shares, and then they sell them off in the market. That's what an IPO is. So tokenization allows you to get rid of the middleman, in this case, the investment bank or banks, and directly make that offering through the blockchain. And that's what's called an ICO, an initial coin offering. Now, I think that's fine. I have no objection to tokenization. If it's an alternative way of obtaining financing for a startup, that's great. It's like crowdfunding or any other form of new technology that is being used nowadays to obtain capital. So I just want to read. I'm going to explain I explained what tokenization is, and I want to emphasize that I'm not opposed to it the way that I have been opposed to crypto. But let's just read what it says, because I think the main issue here is that it's, while good, it's not addressing the real problem that these people are saying that it's going to address. So, tokenization refers to the process of putting major asset classes on the blockchain and digitizing them so that they can be divided into tiny shares that don't exist today. Each of these shares is represented by a token on the blockchain, which also means tokenization offers the greater security that is inherent in blockchain technology. Tokenization's advantages include liquidity and accessibility. Tokenized assets can be traded easily and distributed to a greater number of investors at lower fees. Today, investment in securities is mostly limited to high-income individuals. Purchasing just a fraction of an asset instead of the whole is more affordable for the average people who want to invest. Around 55% of Americans owned stock in 2019, according to the Federal Reserve Survey of Consumer Finance. That number will grow as tokenization spreads. So, one thing. First, it tries to present this idea that, like, a lot of people don't have access to securities, and yet 55% of Americans own stock. That's more than half. That's a sizable majority of people who own stock. Now, there are a lot of services that offer fractions of stocks. This is not new technology at all. Like, you're not prevented from, say, investing in Amazon by buying at least one share of Amazon, which is now really expensive. I don't know what the price is, but I think it's in the thousands. There are services that allow you to buy a fraction of an Amazon stock, and you get the same benefit if the Amazon stock rises than if you bought the whole share. So this is like not a new technology in itself. But the main issue that I see is, okay, why do we need new technology for obtaining capital? You would want to argue that, well, maybe it's because for example, the startup rates are very low. And here's the thing. If you look at, here's a chart from Brookings of the startup rates in various U.S. industries from 1979 to 2014. 1979, before Reagan came along, slashed taxes, slashed regulations, which the argument was this was going to make capital easier to obtain, among other things. And we've seen the exact opposite effect. So rather than encourage business formation, because you would expect that lower taxes and lower regulations, this is the libertarian and free market fundamentalist argument, less taxes, less regulation, more business growth, more startup growth. And the exact opposite has happened. We can in every major industry here. So adding tokenization to the list of ways that you can access capital, is it going to revert this? Is really the problem of like low startup rates caused by the lack of options for raising capital? I don't think it is. There's no evidence from this chart that that's the case. Accessing capital today, you have more options than you did in 1979, and it's cheaper than in 1979. So why do we have this declining startup rate? Clearly, this obeys other structural factors. The fact that maybe there's less people with capital capable of starting a business. Because here's the thing. This idea that like tokenization will enable any asset to become liquid implies that you own an asset already that has some value if it was made liquid. And most people, for example, aren't a meme that they can sell as an NFT. If you want to do an ICO, you still need a business or at least a business project. And that requires capital. So the problem is there's not enough capital around. You know what I mean? Like the problem is not access to more capital. It's the fact that you're parting from a point where you don't have capital. And tokenization doesn't change that. Because you're not addressing the big issues of why, despite the fact that access to capital is cheaper and you have more options, you still have this. So I don't see tokens as an argument reinforcing the whole democratization of finance. I'm okay with its existence. I think it's great that there's another option. My main issue, I think, with tokens is that if it's linked to a crypto blockchain, and crypto has some incredible environmental impacts, which I haven't even discussed, and I'm not going to discuss because I think if I start discussing the environmental aspect of crypto, it's just a non-starter. So I'm not even going to go there. But if there was some way, like, blockchain technology is not dependent on crypto. So if we can pursue tokenization through blockchain technology that's outside of the crypto space, I am all for it. I will not complain. I don't have an issue there. So I think that pretty much settles my objection with this argument of crypto democratizing finance. I will insist. I find it very problematic that these people don't actually give any concrete examples of how crypto empowers people. And the examples that they give can be applied to any other asset, which means that there's nothing special about crypto at all. And what I find most worrying is that the people who are supporting crypto, who are seeing it as this like revolutionary, transcendent technology, just don't bother discussing or supporting the ways that we can actually empower workers and ordinary people, the people who supposedly are going to benefit from the democratization of finance, the average Joes and average Janes. The supporters of crypto never advocate for any other form of empowering these people. They don't advocate, for example, for workplace democracy, which genuinely empowers and democratizes an element of your life where you spend like half your adult life in. They don't advocate for that. So how can you have this double standard of inventing that something is democratic when it's not, and just giving vague definitions and hoping that in the future it's going to change things when you can't give concrete examples of how it empowers people now, while at the same time criticizing, opposing, or simply just not supporting ways in which we could empower people to have more capital, to have a voice and a vote in economic matters, which we don't have in liberal democratic societies. That's not their interest. And I think I gave plenty of examples of sort of the underlying ideology of the people who write articles like this. And you see that throughout the whole crypto space, like the Twitter space and the blog space. So I'm not buying it. I think this is basically snake oil, to be honest. If you made money out of Dogecoin and didn't end up losing it after Elon Musk made bad jokes on Saturday Night Live, good for you. Anything that helps working people obtain more money in like an individual case, that's fine. But in an aggregate case, I think this is not the way to achieve financial democracy. And when you add to this the huge environmental impact of crypto, I think that just makes it so problematic that it's hard to support its continued existence without any sort of regulation and any sort of protection for people. So those are my thoughts. If you disagree, feel free to comment. And if you like this video, please like, please share, please subscribe. New channel, so I appreciate all new subscribers, and I will definitely make more videos on crypto and tokens, because a lot of these issues are quite complicated. And if you're just buying the arguments given by these people, you might as well just be listening to snake oil salesmen, because that's what they are. Anyway, thank you.